For many workers currently entering the labor force, the traditional timeline of retirement is looking less like a destination and more like a moving target. The common perception of the European model, and Germany in particular, is one of absolute stability. The high tax burden is seen as a fair trade for a robust social safety net that removes the need for individual financial anxiety in old age. When we look at private assets alone, the gap between these systems is wide. The average American household holds roughly $337,000 in net worth. In Germany, that figure sits at $183,000. To bridge this gap, economists use a concept called augmented wealth. This combines a household's private savings with the estimated value of the state pension entitlements they have been promised. When future government promises are added, wealth accumulation by age shifts. On paper, German wealth actually overtakes American metrics near retirement. However, 61% of this wealth consists entirely of pension promises, meaning it only exists if the state remains solvent until they retire. This reliance on future payouts creates a situation where financial security is built on the projected tax revenue of the next generation rather than the tangible assets of the current one. This arrangement was highly effective during Germany's mid-century economic boom. The large labor force easily supported a growing retired population without strain. The foundation is the Umlage system, a pay-as-you-go model. In this system, there is no personal pot of money. Current workers pay their contributions, and the state immediately transfers that money to current retirees. In the 1960s, there were 5 active workers for every 1 pensioner. Today, that ratio has fallen to roughly 2 to 1, placing a massive weight on the shoulders of the individual worker. This shift has transformed Germany into a Rentner-Demokratie, or a retiree democracy. Older voters now represent the dominant political force. Consequently, politicians often prioritize high pension guarantees over the long-term investments needed by younger generations. This raises a question for young workers. Why not simply ignore the state system and build a private portfolio of stocks and assets? The barrier is the tax wedge. Between income tax and Social Security contributions, the government claims 40 to 50% of an average worker's salary. This level of taxation prevents the accumulation of private capital. Half of a paycheck is siphoned off to support current retirees, locking younger workers out of the housing market and denying them the ability to build wealth. In a rapidly aging society, the pay-as-you-go model functions as an extraction machine, transferring the financial output of the youth directly to the older generation. The 2019 population pyramid shows exactly where the system breaks. There is a massive bulge of workers in their 50s and 60s. By 2036, 13 million baby boomers will move from being the system's contributors to being its beneficiaries. The projection for 2060 shows a fully inverted structure. At this point, the ratio hits 65 pensioners for every 100 workers. The math suggests that nearly every young worker will carry the financial responsibility for a dedicated retiree. The structural effects are already visible. The retirement age is pushing towards 70, elderly poverty is rising, and immigration flows are not large enough to balance the demographic deficit. Stabilizing the economy will require a fundamental renegotiation of the social contract, likely involving a shift toward capital-funded private pillars and an even higher retirement age linked to life expectancy. For the individual, the takeaway is clear. Tying your long-term survival to government promises is a high-stakes gamble on a population trend that is currently heading the wrong way. Relying on a demographic Ponzi scheme creates a cycle of labor that doesn't end when your career does.